Hey guys, hope everybody's doing great. Got our second video here for y'all, and before we get started, I just want to encourage you guys to really finish strong here and really persevere through this and work hard. I know this isn't an ideal way to end your senior year. But just wanted to give you a thing or two that I think could help. I know not everybody has yet, gotten on a normal routine or a normal schedule. I mean, if you have not gotten on a normal schedule yet, then you're going to put yourself through a lot of pain and struggle here in these last few weeks, grade-wise and all that kind of stuff. So just go ahead and do it. I mean, go ahead and create a schedule that's going to work for you. And that could include sleeping a little later or whatever, but whatever works for you, go ahead and get that done and have a way that something that you follow regularly throughout the week. And it's going to look different for different people. I mean, everybody's at home with different circumstances and things going on. So, but make one that works for you. Your grades and your attendance in these online classes, it's going to determine, if you graduate your senior year and where you're at the end of all this. So go ahead and get on it. Speaking of grades, I put a bunch of grades in on RenWeb yesterday. A lot of it was on the plan a trip activity that we did in class before spring break. I emailed some of you guys who had missing information and stuff. So, if check your email. And also emailed some about some people that haven't been logging in and doing classwork. So remember, you got to log in every day and do your work. And think that we're in school right now. It's different than normal, but we're in school. So I just wanted to start with that. And then I also wanted to review sort of what we've talked about so far. So we've been talking about the stock market, and we talked about that stock is ownership in a company. All right, so a single stock is a small piece of a real big company, but that's what the stock market is, and that's what stock is. And we talked about why someone would want to buy stock, and at the end of the day, it's to make money, right? It's an investment. It's a way to take the money that you have and try to use it to make more money. And people do it different ways. Some people do sort of long-term investing in the stock market because historically, you see an upward trend in money over time. And so maybe it's like a retirement type situation where you're putting money in and it's invested in the stock market. And then there's also people like day traders that are, looking at the regular movements of the stock market and small movements of the stock market and are buying and selling on a regular basis. And for a lot of people, that's like their full-time job. And then there's, a mix in between all of that. But just understand that, you could lose money investing in the stock market as well. So that, right, there's risk and reward. But the stock market, if you're invested in it over the long haul, it's sort of shown to have mostly an increase in value. There's going to be dips and there's going to be highs and lows. But it's kind of like buying a house. Buying a house is considered to be good debt because, 20 years later, your house should be worth more than it is today. So it's not something that decreases in value, but it's something that increases in value. And that's generally what the stock market does over time. Okay. Why do companies sell stock? They sell stock to get money that they need to grow the company. Maybe they have something that they need to work on. They need some cash on hand so they can sell stock to have some liquid cash that they can use. Now, we talked about a stock index, which is a group of stocks, and that could be by an industry or just any other grouping. A popular stock index is the Dow Jones, which is 30 of the largest, the Dow Jones Industrial Average, which is 30 of the largest stocks, largest companies in the United States, all grouped together, and they kind of, it's an indicator of how the economy is doing, looking at the Dow Jones. And then we looked at some individual stock tables and information. So, if you got online and you went to like Yahoo Finance or whatever, and you looked at Apple or you looked at Nike or McDonald's or Walmart, you can pull up an individual stock, which you guys did for your lesson yesterday. And there's tons of information in there. So you can see how the stock's done in the past year, like a 52-week high and low. We talked about how every stock's going to have a ticker symbol of information, and that's just so it can be at the bottom of a screen or whatever, and you can see a lot of information real fast. We talked about volume yesterday. Volume is the number of. I got my 3-year-old walking in here. Volume's the number of shares that a stock trades on any given day. Okay, and for most stocks, it's usually in the millions for big stocks on the stock market. A dividend is a cash payment that a company gives to its investors, and that's on a per share basis. So if you own one share of stock and the dividend is $1, then once a year you might get $1 check in the mail. All right, and obviously that's not very much, but if you own a lot of shares in a company, then a dividend payment could be something that people rely on. And then sort of a daily high and low. All right, today we're going to talk about a few more terms. And the first one is the word portfolio. Portfolio. It's kind of a weird word, but a portfolio. And if you think about a portfolio, not in financial terms, but just in like for someone else's job, like a painter or a photographer might have a portfolio of their work. And you might sort of understand that what that coming from it like that, it would sort of be like maybe a book of all the photos they've taken, where you can go and see everything that they've done, everything that they have that pertains to their photography business or their painting business. But financially, your portfolio is kind of like all your financial assets, all the money you have, and different things that you can do with it. And then a stock portfolio is sort of like all your stock investments, everything you have maybe in the stock market with stocks or bonds. Okay. So your stock portfolio would just be all the money that you have tied up into the stock market. All right. And then we said that there's some risk involved in investing and putting your money in the stock market. But you could also, your stock portfolio, your group of stocks, depending on how you choose to invest them, can be individually more risky or less risky. All right. There's some stocks that you would say are less risky stocks, especially maybe some of the big, strong companies, a company like a Microsoft or a Google or a Walmart, that you just don't see going anywhere anytime soon, would be a lot less risky investments than maybe some kind of tech startup company that could boom or bust. So your company could be more, your investments could be more or less risky depending on how you choose to invest. Now, if you just invested in one single company, would that be more risky or less risky? And the answer is it would be more risky. All right, you're sort of putting all your eggs in one basket. And if that one company does bad, then you would lose a lot of money. All right, let's look at an example of one company investing. If you had invested a month ago all of your life savings in a company like American Airlines. American Airlines is a good company. It's a solid company, but because of all this stuff that's going on, it's seen its stock decrease in value by over 50%. All right. So 50% of your savings for your lifetime or for your retirement or whatever would be gone right now because you only invested in one company. All right. So it's more risky. All right. Now, we would hope that it would come back, and I think it probably will. But that just shows how it's more risky. Or if you invested in just one industry. All right, let's stay with the airlines industry. The airlines industry as a whole is down about 40%. All right. But if you spread your investments out over a bunch of companies and a bunch of industries in a bunch of different ways, then your investments would be less risky. All right. And to do that, there's a word that's used. It's called to diversify or diversification. The more diverse, the more spread out your investments would be, the less risky they are. Okay. And so, there's different ways that you can do that. And most people don't do that on their own. They have a financial company or a brokerage firm or somebody that would do that for them. But most people want to diversify the way that they invest and sort of spread out their investment so it's not all tied up into one company or one industry, making it more risky. But you got to have a little bit of risk. Otherwise, you might not see your money increase the way that you want it to. And our last terms for today are the difference in a bullish market and a bearish market. All right, so you got a bull and you've got a bear. And I'm not really sure if those are the two best animals because both of them are kind of aggressive, similar type animals. And I think of a bull and a bear. That'd probably be a good little battle here. I guess I'd go with the bear. But they have two things, and you've probably seen these words said if you've been watching the news a little bit. Whenever they talk about the stock market, the market has been in a bearish move lately. So the difference here. So let's start with bullish. Bullish means that the stock prices are rising and people are buying, and the expectations are that in the future, prices are going to continue to increase. All right. And so people want to buy now because they're expecting the value of stocks to be higher later, which means that they would then make money. All right. So bullish means things are rising, things are going up. It's usually what you want to see. It's a good sign of economic health and where we're going as a country and all that kind of stuff. Bearish is the opposite. A bearish market means that prices are falling, people are selling, and we're expecting the prices to decrease in the future, which is where we have been over the past month with the coronavirus pandemic stuff going on. Prices have been falling a lot. All right. And last week was really a lot of bad falling. And then this week's kind of been up and down. And been a little volatile and hasn't been a steady up or steady down. But most experts think that we're going to kind of continue in this bearish market for a little bit. All right. So those are our words for today, are kind of our new things for stock portfolio: diversification and risk, and a bullish market and a bearish market. So check out Google Classroom, and I'll have your assignment up and you can knock it out today. See you guys.